I frightened Jasper by sending a 24-slide presentation. I still try to stick to my 20 minutes by going through the beginning of the slides very quickly. But I wanted to give you also a little bit of an overview of what we are doing at the European level in the area of payments, what policy objectives we are pursuing, and what role the European Union is playing in this area. And then, of course, I also want to focus on the second Payment Services Directive, the ambition we're pursuing, and I'll try to answer some of the questions which were raised by the previous speakers, and I hope that we can go deeper into these issues during the discussion. But while I think that I can answer some questions related directly to the Payment Services Directive, I ask myself also lots of questions about the direction in which we are traveling. And I think I'm not alone in the area of payments when it comes to knowing, trying to guess what the future will be. Now, the policy objectives. First of all, payments are an important sector of the economy. In France, it has been estimated there are 90,000 jobs in payments with contribution to GDP of 6 to 7 billion euros, but it's not something which we really want to consume. So if we could reduce the number of jobs and the turnover, it might be better for society, because payments are a facilitator. Payments should be cheap, they should be secure, they should be convenient and accessible, like in the Netherlands, as I have heard. And that at the European scale. That's, of course, our challenge to make this happen, not just in every single member state, but EU-wide. But there can be conflicting policy objectives, or they could be complementary. Very often we stress the conflicts between policy objectives. Can secure payments be convenient? We had this discussion around this regulatory technical standard on strong customer authentication a lot. But I think it's a question of technology. You can develop new technology which can combine security and convenience, and we are seeing a lot happening in that respect. Then can payments be cheap and at the same time offer everything else, accessibility and convenience and security? Well, I think they can be cheap and yet they can be secure, because fraud would increase the cost of the various payment methods, and it needs to be taken into account that the risk of fraud prevents people from using new payment methods and so on, and ultimately the users, the consumers, will have to bear the cost of fraud through higher prices in shops. And again, innovation is the key to bridging or to making conflicting policy objectives actually complementary. So well-designed payment systems promote synergies among the policy objectives. Another question which is important is, of course, who is responsible for delivering efficient payment systems? Can we leave it to markets on their own? Yes, there's still the infrastructure issue. There's a role for public authorities, central banks in particular, and there's clearly a need for supervision and regulation of market operators, including new market operators. So that raises a question, how should we design policy interventions, and at which level, at the national level or the EU level? That's a subsidiarity question. Now, at EU level, we are, of course, very interested in making sure that payment services providers can operate across borders, and we want to avoid fragmentation, so that with your payment instrument, you can make your purchases, your payments, not just in a single country, but everywhere in the European Union. So we have a number of regulatory interventions at the European level, and I would distinguish three types of interventions which are directly targeted at payments, and that is legislation to lower costs, legislation to enhance accessibility, and legislation to support innovation. But there are some other areas of regulatory intervention at the European level which directly, or indirectly rather, affect payments, and that's anti-money laundering rules and data protection rules in particular. As far as costs are concerned, just a brief reminder, we have, of course, established the single euro payments area, which significantly reduces costs for cross-border transactions, thanks to investment in a more modern EU-wide infrastructure, but also through regulatory pressure on market operators to align prices for domestic transactions and cross-border transactions. That has been very successful for Euro countries, but we have created in a way a divide between the Eurozone and the rest of the European Union, where you cannot reach as many people and businesses with low-cost payments, and that's something which we are committed to tackling with a proposal to be presented by the end of March. The vision, just very briefly, of the single euro payments area is that with a single account, you should be able to make all your payments across the single euro payments area. And that mission is almost accomplished. But one problem which we still face is that some payees, tax authorities or public utilities, they still refuse direct debits from another country. So that's what we call IBAN discrimination. That's something which we are trying to tackle right now. But it's a minor issue compared to what has already been achieved. Let me skip the cheaper non-euro transactions. As I just mentioned, we are planning to submit legislative proposals by the end of March. If you want, we can go into further detail during the discussion. Accessibility, very briefly, that's also an objective which we achieved or pursued through the Payment Accounts Directive, which gives every European a right to a basic payment account, complete with the possibility to make cash withdrawals, credit transfers, and direct debits within the European Union. And we have the European Accessibility Act, which is still under discussion. And Michiel knows a lot about that, being in charge of a working group on the issue under the auspices of the Europe Retail Payments Board. Here, a key question will be also for the fintechs, whether they can offer new solutions for increasing accessibility in the area of payments. Regulation with side effects, anti-money laundering directive that has been updated several times, very often in response to terrorist incidents or scandals, tax evasion scandals. Then there's a general data protection regulation, which I also would like to briefly mention. It enters into force in May this year with much stricter rules to protect personal data, but also the principle of data portability, the right to have your data transferred from one operator to another. But there are heavy fines also in case of non-compliance, and banks in particular are worried about their liability in case of transmission of data to third-party providers, account information service providers, and payment initiation services. Now, innovation, that is really a major focus of our regulatory intervention. Fintech has been around for some time. Those payment initiation services have been operating for more than a decade, and we already had regulation at European level on e-money since the year 2000. That's almost 20 years. The Payment Services Directive followed in 2007 and was updated in 2015 to take into account those new services which have already been mentioned. These directives basically recognize new payment service providers, and they facilitate their access to an EU-wide market because they allow them to be licensed for EU-wide operation through so-called passporting. Now, the second Payment Services Directive, it applies since Saturday in principle. The Netherlands haven't yet transposed. We will be sending nasty letters, but not just to the Netherlands, I can assure you. So far, as far as I know, 8 member states have notified transposition of the directive. A number of things which this directive does, apart from recognizing new players on the market, we extend the scope a little bit, so we cover also transactions involving a third country. We have better consumer protection, a ban on surcharges for card payments, for which Theresa May took credit on behalf of the Conservative Party, we found out. Reduced maximum loss in case of fraud to create more confidence in electronic payments. A clear deadline for responses to complaints and a right to out-of-court redress, and more security also through strong customer authentication. And there's a strong role for the European Banking Authority, which has to define standards, guidelines, and also a central register of payment institutions. So there's a whole new architecture which has been developed with the Second Payment Services Directive. But there are some key issues which need to be tackled in a delegated act and a regulation to be adopted by the Commission. Actually, it has been adopted on the 27th of November. The regulation setting technical standards on strong customer authentication and common and secure communication standards. Sounds very technical, but this has been, it sounds very boring and technical, but this has been the most political thing I've ever worked on in my long career in the Commission. It was extensive lobbying. As these regulatory technical standards go, they are drafted by the European Banking Authority, which does consultations of the market and impact assessment, but the lobbying did not stop there. It continued with the Commission. In particular, retailers came to see us. They wanted to soften up the requirement for strong customer authentication and, in some cases, replace it with transaction risk analysis. We gave them that possibility by saying you measure your fraud levels, and if you achieve low fraud levels with transaction risk analysis, that's okay. We can live with that. And the other big fight was between banks and fintechs, and that was over access to bank account data. And I'll come back to that. So the RTS is adopted. Now the European Parliament and the Council have 3 months to reject it, or to say that they're okay with it, but they cannot negotiate. There's no trilogue. So it's take it or leave it. This period could be extended to 6 months if they need more time. We hope that won't be the case. And then we publish it in the official journal, and 18 months afterwards, the market players will have to comply with this regulatory technical standard. Briefly on strong customer authentication. It means that you have to provide 2 elements from 3 domains: knowledge, possession, inherence. Inherence is biometrics, essentially. And by combining those 2 elements, we achieve a very high level of security compared to just providing the credit card details, your number, and the expiry date, and then you turn it around and take another number, and you feel safe with it. Well, you shouldn't. So now we are moving to much stronger protection of electronic transactions. But there are, as I said, numerous exemptions which have been negotiated for low value and contactless payments, transport and parking fees. If you have trusted beneficiaries and recurring transactions, there are exemptions, and then this famous transaction risk analysis. There is a monitoring obligation when those exemptions are used, and we have a review clause for the fraud rate thresholds, which need to be respected when transaction risk analysis is being used. But let's move on to secure communication. That is really the basis for the open banking revolution which we expect to happen. Bank customers, that's a basic principle, must not be prevented from using new services offered by third-party providers. So basically the idea, if I may paraphrase it, is if you can do something yourself with your online banking interface, then you should also be able to rely on somebody else, a third-party provider, to do it more efficiently using the data which you could access yourself. And we have 2 types of business models which are foreseen and recognized in the directive. That's payment initiation services, where the provider triggers a credit transfer from a customer's bank account to a payee, and that replaces card payments in an online environment. But in principle, payment initiation could also apply in a bricks and mortar environment. Then account information services. Here, providers get information from different accounts and offer personal finance monitoring finance management services to customers. And so far, these services have been developed using the screen scraping methods, with some exceptions. Some banks have provided APIs or interfaces for communicating data, but mostly the fintechs have collected the data in the same way as we as bank customers would be getting the data, namely through the online banking interface. That's regarded as unsafe. Everybody wants to get rid of it. The fintechs a little bit less than the others. The existing fintechs. The new fintechs, they would be happy to get rid of it and have APIs which they can easily adopt. But there's also another drawback of screen scraping. It's actually quite a heavy investment because you have to replicate each online banking interface, and that needs to be maintained. Whenever there's a change in the online banking interface, you need to update your software. Some companies have actually specialized in providing these screen scraping models for other financial services providers, so that not every fintech has to do the work itself. So PSD2 requires banks to provide account information and access to accounts to TPPs if they offer online banking to their customers. The communication must, under PSD2, allow an identification of third-party providers through and link to that an exchange of security certificates. It also specifies, the directive itself specifies that only information needed for a payment transaction or for the account information service must be obtained and stored. And basically, we did not really do away with the screen scraping method, provided that third-party providers and banks comply with this identification and security certificate requirement. Banks have the choice to either adapt their customer online banking interfaces to make it compliant with the identification requirement, or to provide a dedicated interface, which would then be mandatory for use by the TPPs. This mandatory use of the dedicated interface is not in PSD2. Here we're pushing a little bit in the regulatory technical standard because of the pressure from banks, from regulators who don't like the screen scraping method. So we're going a long way in their direction. But we also needed to have safeguards for the fintechs which so far rely on screen scraping because we don't want them to be locked out of the market. The risk which you can presented in your talk. We feel that dedicated interfaces are best for rapid development of a new market for payment services, particularly if they can be standardized. Now, if we wanted to have EU-wide open banking, well, we don't have a legislative or a mandate in legislation to make a standard API compulsory, unlike what happened in the United Kingdom with the Competition and Markets Authority. The RTS empowers banks to mandate, in a way, the API, because if the banks offer an API, then TPPs must use it, and there's no more screen scraping. Provided, of course, that the API is of good quality. It must be, it must allow the TPPs to develop their business model. If not, then banks would have to provide, as a fallback mechanism, an adapted online banking interface. But banks, they don't want to invest in that. They want to avoid the costs of the fallback mechanism. So, as a concession to them, we foresee in the RTS an exemption possibility to be given, an exemption to be given by the national competent authority if the API that is offered by banks passes a market test. So if all the market players are happy with the API, then the banks don't have to invest in the fallback mechanism. And that seems to be a very strong incentive for the banks to cooperate with the TPP side. And we're establishing now a kind of evaluation group which will look at API standardization proposals. They will start their work at the end of this month and hopefully move very quickly so that we can actually develop some kind of standardization of APIs. We cannot mandate it, but we can help market players to work on it, and we can create incentives for them to do this. So this is the task of this EU evaluation group. We hope that this will work out. We have already seen a very big change in attitudes on the parts of banks and the fintechs. They are less on a confrontation course than in the past. They know that they are sitting in the same boat, and they have shared interests now. But we have a difficult transition to manage. There's a time inconsistency. PSD2 applies since Saturday, but there are key requirements for secure communication which will only be enforced from around September 2019 if everything goes well with the scrutiny in Parliament and Council. We have grandfathering rules according to which TPPs that existed before the 12th of January 2016, the date of entry into force of PSD 2, so publication in the official journal and so on. If they offered their activities before that date, they can continue to offer the same activities in the same markets as before. For the new and existing TPPs, after they have been licensed in accordance with PSD2, they will be given access to accounts using screen scraping in all member states except those member states where screen scraping had been illegal before the 12th of January 2016. But there's also a requirement in PSD2 for member states to ensure that banks do not abuse their own non-compliance with the security standards to block or to obstruct the use of payment initiation and counter information services. How this is going to be done in practice remains to be seen. We will be putting pressure on market players and on supervisors to make sure that the transition to or the opening up of markets for TPPs will happen as smoothly as possible. There's also an EBA opinion on the transition, which invites market players and national supervisors to comply with the RTS as soon as possible, even before this application date of the RTS. Well, the shape of things to come. There are several drivers of change. We talked a lot about regulation, PSD2, and the implementation of the RTS, and then compliance with data protection rules will be very important. But then there's also new infrastructure, which has been mentioned for instant payments and the mobile payments. That will be a real game changer in the years to come. And then, of course, the key question is how will market players respond to through innovation in a competitive market environment? The impact of regulation, we have the right for consumers to use such new services and an obligation for banks to pass on the information which is necessary for that. We have now created a strong incentive for the market to develop standardized APIs which will lower barriers to market entry. And we have strict data protection rules which will limit certain business models which would rely extensively on exploiting personal data. I quote the relevant article here. You can read it at your leisure, but it will make it difficult for the big techs which want to exploit access to payment data and to make money through marketing. So that's something which will need to be watched closely. The impact of new infrastructure, we have already interesting developments in terms of instant payments in some non-Euro countries. The Eurozone is now catching up. We have the SEPA instant credit transfer scheme, which entered into force in November last year. November this year, the target instant payment settlement facility of the European Central Bank will be in place and will be offering very cheap instant payments. The first application could be for mobile peer-to-peer payments, where we're also working on proxies to make it easy. So, for instance, you could use your telephone number as a proxy for your very long IBAN number. But the real impact for mobile payments will only be felt when they can be used by consumers for making purchases in shops. That enhances further the possibilities of a simple payment account. There will be no need for credit cards because there's no need for guarantees for merchants, for instance. So that could reduce the cost of payments, not for the consumers, they don't pay for it, but for merchants, and that could be passed on through lower prices for goods and services. But who will be the dominant providers of payment services? Could be banks, which can also use opportunities of PSD2 and develop their own attractive apps, and they could compete with credit cards by offering their overdraft facilities. Could be the fintechs, providing more attractive interfaces to banks, and the banks would be mass producing the infrastructure behind. Could be the big tech players, adding payment initiation and account information services to their mobile apps. Could be the mobile phone operators, could be national card schemes, developing payment solutions for a country's banks, like Ideal. It could be global card or e-wallet schemes which might leverage their brands and the global acceptance of their products with merchants. The key question will be how to make money with payments if you're not the payee. And then this is the last slide. I'm sorry for that, yeah. You can continue to levy charges on merchants, but if there's a switch to instant payments, then there's not much money to be made because instant payments will be that cheap. Account fees, that is not very well accepted by consumers who have grown accustomed to accounts which are free of charge. Maybe free payment accounts could attract customers for other services. It could be bundled with something else. There can also be fees for payment instruments with premium features like insurance, chargeback rights. That's the case with credit cards. But the last possibility, personal data and the marketing possibilities linked to that in exchange for free payment services, I would put a big question mark because that does not seem fully compatible with what we have in PSD2. Thank you for your attention and sorry for overrunning a little bit.